Hey everyone, me Kevin here. So let's talk about the weenie babies and the Fed. First things first, we already know that the weenie babies have kind of U-turned. They're not so worried about bond yields anymore, going up to the moon. They were worried about the little shonk-the-toodle-oodle-doodle, and now they're over the shonk-the-toodle-doodle of rates or bond yields going up. So now the whole market is kind of like, okay, all right, cool. We don't have to freak out about bond yields anymore, but everything's kind of still in shambles in terms of EV and tech, and even recovery's down a bit, but the indices are flat, and it is the weirdest, most bizarre market ever to be in. That's because we don't really seem to have a clear direction. But what we do have is more insight from the Federal Reserve in terms of what their inflation expectations are. And I want to give you a chart here that is a very high quality production of exactly what's going on, so that way you can understand what's going on. And so what we're going to do is we're going to zoom into this chart and understand this, because this is, I think, going to really help us so that, we can go with a few less Topo Chicos. All right, let's jump on over to it. So here's the scoop. First things first, we have got to understand that in 2020, obviously the Federal Reserve swooped in to bail things out and on a Sunday dropped the federal funds rate to 0. That was 2020. But something interesting happened at the beginning of 2021. Jerome got a little pissed off. That's because Mr. Jerome Powell kept getting yelled at about, come on, man, we know inflation's coming. What's going on? He's like, dude, I've been telling you all of 2020, I want inflation to come. No, duh, inflation is coming. I've been saying inflation is coming. We literally have been saying we want there to be inflation. We want inflation to go to 2%. In fact, we want it to run hot. And even though we want inflation to go to 2.5% or potentially slightly above that for a little bit of period of time, we're going to just call it FATE. Literally, that's what we're going to call it. Flexible Average Inflation Targeting, FAIT, FATE. And it'll all be fine. Inflation will run hot and it's cool. And so as soon as we start seeing inflation, market freaks out, throws a hissy fit. We get February 16th, top of the market, to February 19th, beginning of crash, all the way through, essentially March. And now, even though lately it's kind of felt like things have been recovering, a lot of things are still left in the doldrums because things are a mess. And see, we had pissed off Jerome. Pissed off Jerome is basically, or was, yelling back at the market, going, dudes, this is what we planned for. We ain't doing anything. And the last thing the market wanted was a Jerome Powell, who had always been there to just print more money to solve problems in the market, going, I ain't doing anything. I see some inflation fears. I see higher bond yields. I ain't doing anything because this is what I want. I want higher yields. I'm winning. Yeah, well, that didn't work over so well. And so pissed off Jerome lasted about 2 weeks. And after pissed off Jerome settled down, I still remember a very clear Thursday when we live streamed him, and he was being pretty pissed, and the market was basically just tanking while he was talking. But anywho, pissed off Jerome did not work. So Jerome was like, okay, I gotta be chill, Jerome. I gotta treat everybody like the true weenie babies they are. I gotta coddle them. And be nice to them, and talk smooth to them, and reiterate to them that don't worry, I'll tell you way in advance of any kind of changes that we plan to make, and when we plan to make them. In fact, we'll even give you some breadcrumbs of hints in terms of when we're going to make changes. And folks, today we got a breadcrumb, which we're going to talk about in just a moment. But this is all the beginning of 2021 here, right? So what are we expecting going forward? We're going to expect continued support, at least now, from the Federal Reserve. $120 billion of monthly bond buying, $80 billion of treasury bonds, $40 billion of mortgage-backed securities. We're going to continue to see the Federal Reserve prioritize how important it is to not only have stable prices, but maximum employment, with emphasis on max, which would include race, sex, equality considerations. And we're going to see temporary inflation, but that we don't expect that inflation to be persistent, that the supply chain issues causing lumber, sheet metal prices, used cars, houses, stocks, and pretty much everything we could think of from going up, don't worry, it's temporary. Nothing to see here, folks. Jerome Powell says it's all temporary, and he'll give us clues as to when things are going to change. Well, again, today we got a little bit of a clue. And so this is 2021 on the chart. And the clue that we got today is pretty unique because it's subtle. but nobody else is really talking about it. And it is a clue as to when we actually expect this temporary inflation to start subsiding. When do we think temporary inflation is going to go down? And once we see temporary inflation go down, then we know how the Fed might be able to respond. Just to give you an example, let's say right now we are at 1.7% inflation, which that's their version of inflation, okay? Let's go with it for a second. Let's say in their world, we're at 1.7% inflation. Let's now say in their world, we go up to 2.9% inflation, averaged over the next 6 months or whatever. At some point, and we're not exactly sure when, but the Fed gave us a hint today, at some point, that inflation is expected to trend back downwards. Maybe, or it'll just go to the moon and then we'll have bigger issues, but let's go with their story. Let's say it begins to trend downwards. Well, the theory is, if we go from 1.7% inflation now to say 2.9% inflation, and the Fed wants an average of 2% inflation, the time the Fed probably expects to raise rates is after this inflection point, probably not before the inflection point unless this keeps going over 3%. I think then we start realizing, okay, maybe we need to tighten sooner. Until we get to that 3% figure, probably expecting the Fed not to do anything. 2.9%, it's fine. 2.5%, fine, whatever. When that starts trending down, at some point, and if it trends down, right? If it trends down and when it trends down, at some point, we're going to hit a new number. Let's say that number is 2.4%, just for the sake of argument, or 2.2 or 2.3%, whatever. Whatever that number is, and when that number comes, is probably when the Federal Reserve is going to want to say, okay, we went through this temporary cycle of inflation, which is depicted here by these scribbly lines. See right here, that's the temporary inflation that we saw. We went through that period. Now, inflation readings are starting to trend downward, and now they're going to settle at some place, ideally in this perfectly scripted world that scripts always work for. Anyway, when inflation hits this new level, after the temporary inflation goes away, the Fed will probably be most equipped to say, okay, got it. So it looks like inflation is leveling around 2.5 or 2.4% or 2.2, 2.3, whatever. In order for us to get this continuing down to our 2% target, now we have reached the point where it is time for us to say, let's raise interest rates to, let's say, a 1%. And maybe that 1% federal funds rate up from 0% will help push inflation down to 2%. And then we'll find our happy equilibrium where if inflation goes down too low to say 1.9, maybe rates go to 0.75, or if inflation goes up to 2.1, maybe that means we need to go to 1.25, whatever. The point is we play equilibrium market maker and trying to figure out where rates should be so that the market is happy. This is all, in my opinion, the dream of the Federal Reserve. And I say it's a dream because this vision, this dream, assumes that we're not just going to see inflation go like that, which obviously would be very bad. But knowing that this seems to be the trajectory of the Federal Reserve, we can actually now chart potentially where this is. And now I've already mentioned this, so if you've been watching all the videos on this channel, this part's not going to be a surprise. If you haven't watched this part yet, that's okay. This will be a surprise because the Fed actually gave us data on this. But it's important to see where that falls into context, which is the whole purpose of making this video. I'm not trying to rehash old crap, old news. My goal is always to educate and help you grasp what the Federal Reserve thinks. Now, whether you believe them or not is totally different. But it's good to know what the Fed thinks. Okay. And this is obviously my opinion of what the Fed thinks, because the Fed, as much as they try to tell us, they use like a different language to explain these things. And they also tend to dodge lots of questions about this. So what did we hear? Well, today we heard that, well, first of all, I'm going to make a note here that we'll probably see that higher inflation, that temporary inflation, in that period of time between April to July 2020. That's an expectation that we've had. And that's mostly because in April, in 6 days, we're going to get CPI data, and it's expected to be not pretty because we're going to get our first year-over-year data, and we're thinking inflation is going to be well over 2% year-over-year. We also want to pay attention to that month-over-month inflation, see what those stimmy checks did. If anything, it might be too soon for them to really be counted. But anyway, we're definitely expecting higher readings for the next 6 months, April to July, August, September, October, somewhere around there. So not necessarily ending in July, but next 6 months expecting that higher inflation. Kathy Wood over at ARK Invest, she believes that inflation will start subsiding or going down somewhere around August to September 2021. I kind of fall into that same boat, the August to October range. And so this would mean Kathy right here thinks that inflation starts inflecting down, and I'm in the same boat over here, somewhere between August to October. However, the Federal Reserve gave us something totally different today. Oh, good old Fed. Federal Reserve says, nah, we see inflation edging down in 2022. So if inflation edges down, if this number, instead of being August to October 2021, is actually a 2022 number, then we can expect at some point between this 2022 number and a rate increase, which is actually more like over here, there we go, somewhere between these points along this path here, we are going to have the Fed taper. So maybe when we hit the inflection point, they stop buying as many bonds. Sometimes this creates a taper tantrum in the markets, which some folks think is going to create a really nice buying opportunity in the stock market. Then, after we see the taper, we'll see those rate increases somewhere around 18 months later, which if we see the taper at the beginning of 2022-ish, maybe we'll see those rate increases somewhere around mid-2023, which is roughly what the Federal Reserve has reiterated. The market sees a rate hike earlier. They see a rate hike in the second half of 2022. The Fed sees a rate hike in 2023. So this kind of gives you a trajectory, a path of the madness that we're expecting now. So right now, just so you know, we are on a roller coaster. We're ratcheting up. Ding, 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 ding. And at some point, we're just going to keep ratcheting up on this inflation number. And we don't know how high it's going to go. We have expectations it's going to end up somewhere around 2.5% to 3%. Then we're going to go on the roller coaster ride down. Whee! And the reason it's going to be, whee, everything's going down, is because that's probably when the Fed might consider starting to taper, when inflation edges down. And especially as they gear up to raising interest rates, which right now they expect to do in 2023, which presumably they would do once they figure out, okay, how low did inflation go naturally? Or did it settle? And what else do we need to do to keep it going down? So, that is my map for the Federal Reserve. If you like the way I explain things and you like my perspective, consider joining my amazing programs on building your wealth. You get lifetime access to all the content, all the new content I add, whether those are my trading ideas or options, contracts, fundamental analysis, real estate research, learning how to negotiate real estate deals, you name it. Check it out down below. Use that coupon code, and folks, we'll see you in the next video.